Okay, thanks everyone for joining the space and Twitter Spaces and YouTube and Twitter Live. On Twitter Live, I'm going to be showing some slides just kind of in support of the communication here. And then on Twitter Spaces, I'm going to have this space for about an hour. And then maybe I'll open up for speakers and others that, just kind of have a continuation to the space. I'm trying to see if I'm actually live, so just bear with me kind of logistically here. Just trying to see if I'm even on Twitter right now. Oh yeah, I can see myself. Great. So thanks everyone for joining. So I'm gonna start from maybe getting a little philosophical here, but I think those will be key points kind of to advance the conversation um, forward. And today I'm going to spend a lot of time kind of going over um, mainly data. So on the slides, you will see that I'll cover a lot of the US supply demand data, the inventories data, what I think is kind of happening. But before I go there, allow me to get a little philosophical. So what I'm showing here is a map of population hubs for early humans and kind of the decision making that was taking place for humans to kind of move from different continents and kind of migrate and what incentivized them to do so. And you could see like at any point, any one of those early humans could have decided, hey, I'll just stay here. I'm just happy where I am at. I don't have to go anywhere. Or maybe they, were really struggling to, in their kind of survival for food, or maybe there was some violence and they had to migrate. Maybe they're forced to migrate. Maybe climate changes over time forced humans to migrate to maybe warmer places. But in overall, they could have said, okay, we're just going to stay here. And there was a decision to make whether you move or not move. And sometimes when you go to uncertain kind of horizons and navigate, nothing guarantees that you're going to have a better time in this new place unless somebody told you, showed you maybe, kind of history matched it for you and told you, hey, it's actually quite good here. You should kind of navigate that way. It's going to be much better. Your life going to be much more fulfilling. And I think sometimes in the markets we don't appreciate the fact that we have choices, and often we can look historically and just take a look at what took place, see the rationale behind how people were making decisions, why they chose maybe to move on something, for example on the supply of oil and gas, why companies chose to actually produce oil and what kind of incentivized them. So I think I want to keep this within that context, and then really to see what's the incentive kind of going forward, whether it's bullish supply, bullish demand, or how humans are likely to behave going forward. So I think there's really important context to that. Before I start and kind of continue, just this is mainly for educational purposes, not a financial advisor by any means, but I will be showing some data. Don't act on it by any means. I will not talk specific stocks, but more kind of share my thoughts holistically about what I think is happening in the oil and gas sector. So basically, populations decided to move or not to move, just like every human today is deciding whether to invest in the stock market or specifically in the energy sector. And so some of the data that I hope to show today maybe give some insights one way or another for many of you to kind of how to proceed going forward. Humans have this very unique element about them where they just may choose ecosystems. For example, witch hunt used to be a very real thing in the past. Humans could just decide, hey, we have bad weather or something is not going our way when it comes to our society, and so there's this community of ladies we can blame, and what a great idea would be to burn them for some reason, right? To really kind of come to terms with maybe something will work out. And so I think what I'm trying to say here is that humans can kind of enter certain ecosystems believing in something, and then while realizing maybe there is a pain gain kind of benefit, supply demand, and how overall society kind of, or individually how people benefit from it, maybe essentially deviate from that ecosystem, saying, you know what, actually burning people is not a good idea, witch hunt is not cool, or maybe seeing by conducting those actions that maybe there's no better times or nothing changed. So this is also something important to keep in the context, because humans have this tendency to say, okay, oil is bad, or gas is good. Oh, gas is green fuel now. We're going to transition to gas. Or coal is better, but coal was good before, but now it's, but now when you need coal, well, it's much better because we have Russia war in Ukraine, and so we're not going to go coal. So there's like all those ecosystems that we have to be in mind, we have to be mindful of. And this is within the context of, I'm going to be showing some supply, demand, and inventory charts. And something to consider that in 2014 we did have an oil glut situation, and that was mainly kind of driven also by various parties not getting along, right? Basically, Saudi saying, "Hey, we're just gonna oversupply the market, and this is kind of the ecosystem we're gonna be at." And then right now we have a very different type of OPEC environment where Saudis could say, well, we're just going to take the barrels. We're going to kind of sacrifice ourselves in a way to maybe try to control the market here. And some could say, well, it's a demand concern. Maybe they're trying to be proactive ahead of the market to limit that demand. But basically, we have to be mindful of the fact that humans can have those abilities to kind of come up with, ecosystems and then eliminate them after a certain amount of time. The next slide I want to show here, and again, if you're confused on Twitter Spaces, I'm live on Twitter and live on YouTube, just sharing knowledge, some research I've done about oil glut in the 2010s, and just trying to really kind of put a picture together about what I think is happening, and then allow each listener and viewer of this to kind of come to their own conclusion. But in a way, what you see here is basically Kahneman and Tversky's 1978 loss aversion theory, prospect theory graph, where on the right you can see the gain. So when you make money within the context of what we're doing here, and then loss when you lose money, you can see in the highlighted squares, you can see clearly how when you win, you take a lot of joy, but then the joy kind of plateaus. Maybe that explains why if you get, reach a certain point, your happiness incrementally is not much higher. You're not infinitely getting happier because you have more and more money at some point. It just plateaus. And I assume it will be very individual for each person. But when it comes to loss, the angle, the drop on the side of the pain, on the disutility, as you can see on the y-axis, becomes very sharp. So, and again, going maybe to early humans, you may be in an environment that you chose to migrate or chose to make a decision. In our case, maybe chose to buy a company, and all of a sudden you're losing and you have much regret. And for those early humans, that regret could come in the form of, oh, I didn't have any food. What did I do? I'm going to be cold. I'm going to freeze now. That was a bad idea. And so every incremental day may not be a day that you're going to make it in the world, right? Because maybe you go hungry and every day you feel the pain more and more and more. And so from an evolutionary point of view, you're meant to feel the pain more than the gain. And that's kind of what I think is happening in the stock market, and really being explained well by Dr. Daniel Kahneman and Amos Tversky in their theory. And so I think what's also interesting here within this context of what I'm going to be showing here is the concept that the oil industry, for example, been through a significant amount of pain for a very long time, and we're going to see soon in numbers. And so what does it mean when it comes to supply and demand and inventories as we kind of evolve here, and we compare kind of the thesis of those emotions to the 2010s oil glut, which is well documented. And I'm going to be kind of going over some recent numbers of what we've been seeing. And my true attempt here, and if there was any value you would get out of this, is the concept of zooming out. I think one has to zoom out sometimes, because even today I was on Twitter Spaces and I was actually a little bit offended. The gentleman made a comment saying, where's the com community? I haven't seen their space. They used to run all the spaces for so long, and now they're not running spaces. Well, guess what? Like, my happiness and the happiness of my family has nothing to do with my participation on Twitter or my duration for my investments, right? And adding value to the community, we can all do in different forms. But I just refuse to accept the fact that somebody is making decisions in investing or not based on the amount of spaces that some people will have or not have. And it takes a little bit of courage to step up out there. And, I really respect people like Shabam and Sohaib as well, that kind of trying to do their best to share with the community whatever they can, whenever they can. And obviously, sometimes it's not the easiest ride. You do have kind of this utility of the form of pain and the loss that you could feel sometimes. But hey, some people do extremely well even in this cycle. kind of keeping in mind the concept of cost of supply, and we're going to be talking about this a little bit more as well. But I definitely kind of refuse to be in the camp where you should be judging your investments based on somebody's emotions. I think it's really important to look at the data, zoom in, zoom out, but make decisions based on data. So in the next slide, what I'm showing here is the oil price, so WTI. I picked WTI, and by the way, we can slice and dice all kind of data sets, sharing basically, world inventories, share, Chinese demand, Chinese supply. But in this specific case, I really choose to focus on the United States. And the reason why I focus on the United States, because it's a really great proxy to what's happening elsewhere. It's by far, I think currently at least, and probably for the foreseeable future, is the greatest nation on earth, right? Is the economic engine of all nations. It's the most powerful nation. It's a nation that dictates basically through its dollar value everything about other currencies. This is just reality of what's happening, regardless of your view on crypto or gold. But right now, what United States is doing is basically the biggest oil producer and also the biggest oil consumer when it comes to the products. United States also is a big exporter and a fairly big importer. And so once we start looking at the market holistically, we can come up with a shape kind of the curve or maybe the kind of the slope, not necessarily just taking measurement of the overall slope, but taking a small segment, which will be very representative of any other data that we could see out there. And so I think it's really powerful to look at the United States more specifically. And so what you see here is I added the stocks total, crude plus products plus SPR. Those are the estimates. So I didn't put the actuals, but actuals, I did a correlation and they're very close. So if somebody wants to pick on me for, I didn't put the actuals, I will have the actual oil supply and other charts, but in this case, I put kind of estimate because I really want to plot the weeklies and explain on the weeklies because the weeklies are not official. And so what you see in here essentially is you saw this big run. And by the way, we're going to be comparing now all the data sets, kind of what took place, whether supply or demand impacted, the movement, and trying to relate back to kind of the 2010s, the oil glut of 2010s. So what you saw kind of at the beginning of like post-dot-com bubble, you saw basically oil WTI in the 30s. And on that scale, the stocks, so the crude and the production and the SPR, they were essentially flat around, I would say, 1.5 billion barrels, right? And this kind of continued until 2004. And you saw increase in oil prices, but you also saw increase in inventories. It has actually very little to do with U.S. production because as we start kind of discussing the different timeframes, I will show you what oil production was doing in the time frame. So between 2000, and I'm showing right now in the slides, between 2000 and 2004, oil production in the United States was actually declining. And in the process, post-dot-com bubble, the oil prices actually went from, I would say, 30s to even mid 70s for that cycle. And then you can see it had this huge run towards basically the great financial crisis with an epic collapse that happened there, mainly on demand, and we will be talking about that as well. But you can see how the cycles pre-US shale revolution were not really supply dependent for at least for the United States. It was driven mainly by kind of like global supply demand and the producers that were contributing to oil production back then. So if we go back to this graph, you can see the oil price had really this enormous run towards 130, and then it really collapsed through the great financial crisis, 2007, 2008. And then it had a really nice recovery, but that recovery was kind of in line with basically the increase in inventories. I think at that point, SPR was probably at that peak, maybe like 740. We're going to be looking at this as well. But then over the next basically 4 or 5 years, you had between 2009, I guess, to 2014, you had really interesting cycle, which I personally enjoyed as a working in oil and gas industry, where oil price fluctuated between I would say 80 to maybe 110, right? And so one could say, well, what's been going on there? What's been happening there, here, right? Like, so we can see the inventories, the SPR, the products, the total crude didn't really change much. It was just kind of going sideways. But really important thing that was happening between this time frame is the US shale revolution. And you can see this was sustained into this price environment that was highly elevated. And you can see oil production back then for United States. So the units here are oil production rate at 1,000 barrels per day. And this is in thousands, so this is basically millions, right? So it was roughly, I would say, 5.6 million barrels a day. And you can see essentially a 45 degree slope. And by the way, like this chart is real. Like this is actual data how oil production increased in the United States. And over the next, I would say, 3-4 years, you essentially had a 45 degree slope in oil production, where United States added 4 million barrels a day to basically the markets. And you can see, despite that fairly game-changing event, the oil prices were elevated. Well, going to my initial kind of conversation about human incentives and migration for early humans, let's say you win in something, or you got yourself to a place of happiness, and then you go to the next place and the next place, and you end up in Hawaii, and it's even more amazing. So you get more incentive to travel and to see more, like to get more food maybe for your family, and you're winning. So you're in this kind of continuous winning path. And that's clearly what was happening when it comes to funds flow, capital in the United States when it comes to growing production. You couldn't lose, because every time the oil price will decline, let's say by September 2011, it declined from 110 to maybe 80. There was slight slowdown, but as soon as oil prices picked up, you basically didn't see any rigs dropping, and you saw price basically oil production continues into this trend, which is a 45-degree angle. And this obviously ended quite epically, towards the end of 2014, where oil price collapsed from, I would say, 100 on this scale, and I don't have every data point here, maybe 120, 115, collapsed to roughly $40. And so obviously you saw supply responding to it. Not as much, not as crazy as what we've seen maybe on relative basis with COVID-19 drop, but you did see some hesitancy when it comes to capital deployment, active rigs. And at the same time, just think about the emotional aspect of it. You are in oil and gas business. By that time, you've been 4 or 5 years into it. You know exactly what you're doing. You're probably making money, I guess, even though many investors in that throughout the cycle did not make money. And so you have very little incentive maybe to stop. You're really kind of emotionally trying to fight it. But then oil kind of stays lower from the beginning to 2015, essentially till for the next 5 years. Now, despite that, once you had this kind of huge decline in 2015, and this is, I will be speaking in detail about kind of what was taking place there, you saw this significant, another leg, of 45-degree angle. Once again, I literally, to show the trend of what was happening, I literally copy pasted the same slope, the same kind of trend line, and put it exactly there. And what you see is exactly another 4 years of the same production at the same pace. And again, giving you another 4 million barrels a day. Basically, you had 9 at that point, basically in August 2016. And then you were kind of riding into COVID without knowing that COVID is coming in early 2020. And so right now, it's an interesting situation then, because it's a different environment. Because right now, if people were making money between 2011 to 2014 and getting this really nice oil prices, you could not go wrong, right? Because you are between 80 to 110, you have opportunity to try things, to innovate, maybe but you're really incentivized to keep going, to producing and getting more and more and more. And so what we see basically in 2016 towards 2020 is another one of those attempts to keep going. But guess what? The price never responded to that. There was a small kind of increase in prices in this 2018, early 2019 timeframe. But that didn't really change much for the plans, because capital was just going into the industry. And there was a little bit of an effect for management teams. It's like, hey, wait a second. We know now that we're in this environment of growth as a sector, right? We're being incentivized to grow production. And you've seen basically inability to comprehend that this time is different, that oil price is not really realistically catching up to the previous levels. and now you're basically not making as much money. So it's really big difference if you, let's say your cost of supply is $50-$60, and the price realized you get paid $100. It's very different than that and getting actually $50-$60 or breaking even. So at this point, your main goal is just like keeping your job, right? And then on this chart, you can see how we go into COVID-19 area, and we essentially kind of collapse here on oil production, and then we have this actual recovery. So this is an actual, this is not an estimate. And you can see, so I plotted basically a line here to showcase like where we would have done if we've done exactly the same two legs as before. So basically from the beginning of 2019, which is the bottom for people that like drawing, kind of do technical analysis and stuff, you would see that basically for the first year of COVID-19, there was this immediate shock, because we were kind of in this wave environment. You guys may recall, like we went to wave one, then we went to wave two, then there was like this supply demand. Like, are we being incentivized to produce? Should we bring in rigs online? Nobody guaranteed, even in the previous leg, and this leg lasted for like about 5 years, that you're going to get paid in the first place. And now you have this huge shock to your system where you're like even questioning like, hey, am I even going to get paid? Like, even if I was getting 50-60, kind of is a break even, getting basically nothing, maybe $1 or $2 versus the previous cycle. Now oil prices actually went negative. And I think at this point, it kind of takes a psychological toll. And I think what's really important is to keep in mind, like what I was saying before initially about how humans, early humans that migrated and kind of how they saw, their response. Like imagine you, like, I don't know, millions of years ago, and you're faced with a situation that every time you take a step forward, you have a basically, disappointment. You're not winning. So are you being incentivized to continue going? Or are you being incentivized maybe to do something else or to go in a different direction in the first place? And I think like through academia and industry, that's what we've been seeing, not only through the layoffs that have been realized between this horrible time frame between 2014 to 2020 when the sector went through so much pain, but also people essentially leaving the industry and academic, not too many kids wanting to like take maybe petroleum engineering, chemical engineering with focus on energy, because there's just no incentive. Because for a very long time, this used to be the status quo. And remember, I also started this presentation by talking about kind of the very obviously an extreme case, but this kind of witch environment where society just decided, hey, we need to burn witches because they're to blame for everything. And so it takes time when, and then it takes time for you to realize, hey, wait a second, it doesn't even make any sense, right? Like there's this time frame that passes. You're like, why are we hurting these people? Nothing really, our life is not improving by any means. And so time kind of has this effect to change your psychological state when it comes to, wait a second, I don't really want to kind of do more of that. I don't want to really hurt these people. Or in this case, maybe I don't want to take on this additional risk and to have infinite amount of rigs drilling for infinite amount of oil, because psychologically speaking, for the past 5-6 years, I haven't done as well as this previous cycle that I already forgot about. So going back now to what's currently happening and just trying to relate kind of those cycles, and we'll be talking in detail about the oil glut, to what's happening with the inventory. So you may see here that the inventories didn't really change much. So at this time frame, United States became this huge exporter of products and oil. So they started managing it really well. But when 2014 happened, this inventory, there was nowhere to ship because there was slower demand, lower economic growth, starting early 2015, and that resulted in what you see in this graph. Essentially, the stock total crude products and SPR going from 1.7 billion barrels to roughly 2.05 to 2.1 or so, and that was a huge shock to the system. And you can see this kind of inverse correlation between the oil prices declining and those inventories basically going to the moon. You had another leg of that going into early 2020, and we know the reason why, because it was COVID-19, right? But guess what? After the oil price collapsed at minus 37 for early May 2020, you had oil prices actually starting to recover, realizing that society will need to reopen, society will need to function. And you can see kind of what happened to inventory since then. So basically from the 2.1 billion barrels on the products, total crude and SPR. And again, any of you, and I'm sure many of you are super smart people and thinking, why are you not using global data? It's all the same basically. It's just different numbers. It's very correlatable, very proportional to behaviors of other stockpiles. And similar thing, by the way, I'm not like a China expert by any means, but everything there, and I will kind of allude to that, is a function of, oh, I expected one, but something else happened. So there is kind of a time effect delay. So then you can see on the inventories, we're going, um, I think, yeah, so February 27th, 2022, unfortunately, Russia decides to move on Ukraine and attacks Ukraine, and you can see oil prices going to infinity. Now, another issue I think that's been taking place is that people have been saying, well, when oil price goes to 120, um, because you're, let's say you're a bull, and it wasn't like basically said towards me, it was towards somebody else. You justify it as a legit reason for oil price to be elevated. But when oil prices decline, you can always say that the market are disconnected between the paper markets and the physical market. That's kind of, and somebody on Twitter that I really respect got really personal about this specific topic, and I kind of listened to it, but I really wanted to address that. So what you see here, basically, since the war started in Russia, you can see this huge disconnect between the inventory's response to supply demand of what's been happening and the oil prices. You no longer see basically any correlation that you would expect. For example, in end of 2014, beginning of 2015, we saw a significant increase in the stocks, right, in the stockpiles, and then we saw oil price collapsing. We saw towards 2020, we saw another time where we saw this huge increase to 2.1 billion barrels, and we saw a big collapse in. But this has something to do with the real physical world, where people were like, hey, if you get out of the house, you die. Like that was the environment. If you like, you cannot not wear a mask or be around people because you may hurt them. And so that response created an environment where there wasn't as much demand, and now the inventory is actually increasing, and there is a physical reason to explain that. Now, with Russia, it's something very similar where it's like, oh my God, this is one of the biggest producers on earth, right, in oil and gas, and now they're going into this like crazy territory, crossing or all kind of boundaries of what anybody ever expected, and attacking a neighboring nation, basically going to, what are the consequences of this? Is this physical? Well, it's definitely physical, we know it by now, but was it paper related? I guess because there's this expectation that you don't know what they're going to do next, and so there was this response to the oil prices, and then you saw basically decline. And now the decline, what we're seeing, and I think that's why it's important, is basically we're going sideways. And I have another slide to show here, which is basically the same graph, but in the shorter time frame, where you can see we essentially had this huge increase in oil price. We saw the decline. And by the way, within that time frame, you had many companies, by the way, that survived this entire cycle. Look at 2014 timeframe. Oil prices goes to 50, then it goes to 40. Then by end of 2015, oil price goes to 20. It goes to 20. It gets stabilized around 45 WTI. 45 WTI. Huge amount of layoffs that's taking place here between 2017 and 2018. Oil prices recover a little bit. Again, in line with the declining inventories. So there's fundamental reason to that. But then again, fundamental reason and good reason, physical reason for the 2020 events. But now, guess what? If we look at what's happening right now, we're essentially going sideways. And I think the reason why we're going sideways is that there's this big uncertainty about future demand, right? And there is kind of uncertainty about maybe like the supply is going to be picking up with the previous trends that we've seen from the United States. But we kind of know that it's true, and we're going to address it very soon. So what you're basically seeing here is around the SPR products and total crude stockpiles, essentially it's going sideways, and oil price is kind of going sideways here. So this is a fascinating fact. Now let's zoom out right now. Now, if we look at the purple line, which is essentially where we are right now, we're at about 1.62 billion barrels on the stock total crude products and SPR. Look at what level we are historically speaking. We're not in the moon somewhere like we were at COVID-19 timeframe, or when we had the oil glut of 2014, 2015. In fact, if you draw a horizontal line, we're right now on those parameters, we're at 1999, 2001-ish, 2002 levels. So we're like at multi-decade lows here, right? Okay, is not legible. Somebody commented, but yeah, sorry. Data on the X and Y axis is not legible. Not sure what's going on here, but sorry if I made a mistake somewhere. But my apologies, Samir, if you comment on that. All right. So what ended up happening is that we're basically going to very low levels here of, and this is mainly a function of SPR, because if you start thinking about what SPR did here, so we were at 2.1, now we're at 1.6. Well, where's the 350, right? So the 3.5 that the 350 million barrels that were gone from this chart, well, that's the SPR. And some say, well, maybe we don't need to refill the SPR. Maybe, maybe it doesn't matter. But on the commercial side, we're kind of fairly steady here. Another thing is the products that are also kind of very interesting because we're seeing increasing demand. Okay, so let's keep going. So going back to the oil production here. So when it comes to the supply, you definitely do not see the same behavior in the United States when it comes to growing production. If you saw the same behavior, in 6 months, you should expect maybe 14.5 million barrels production. So today we're at 12.5 with rigs dropping. So we're actually seeing a little bit more kind of discipline from management teams, not chase the production. And I think there's a little bit of a shock too, because remember, mentally, as we were going from wave 1 to wave 2 to wave 3, with now China reopening, not knowing what's going on, nobody guarantees to any of those management teams that they're going to get paid, because in your kind of recent memory, you know that you've been through this crazy cycle between 2014 to 2020 where not too many people get paid, right? And so this kind of creates a very interesting environment, but also comes to supply and demand. So let's look, for example, at estimated jet fuel demand. I think this is kind of a useful data point that I want to use when it comes to the strong demand we're seeing, and maybe talk about kind of the oil glut from 2010 in more detail. So for jet fuel demand, this is the estimates. This is not the actuals, but it really correlates well with the actuals. 9/11 was a big event, and you can see here that basically from you saw increasing demand for jet fuel. I think it was like 1.8 million barrels, and then it really dropped to 1.4, so a 20% drop. And 9/11, I don't know many of you, so I was like a young guy. I was in my really early 20s, and it was a big shock to the system. It was like, oh my God, it's not safe to fly airplanes, right? But as you can see, over time, with the oil prices increasing from that time point, totally unrelated, uh, over time, people kind of like, hey, I think we're okay. I think we can fly again. And so through the more security enhancement and regulation, you saw basically people went back to around 2004 to flying pretty normal. Remember also that throughout this entire cycle, when it comes to gasoline consumption or jet fuel demand, there's significant amount of optimization that's taking place, right? There's better technologies, better engines, like better planes, more efficient planes. And so despite that, you have basically very good demand for the products in an environment where oil prices are increasing and fuel price increasing. So you can see basically in the great financial crisis where oil price collapsed, obviously the entire on the demand side as well, there was big shock to the system. And so that jet fuel demand declined to even further to roughly 1.4 million barrels a day to 1.3 on the product side. But you can also see that it kind of went sideways, slightly increasing on a seasonal basis, despite the very elevated oil prices. Now, what's really interesting here that I discovered that I really wanted to share with the community is that when the oil glut happened, when kind of the Saudis started like getting into this price wars with, and again, think about those guys. They're seeing United States now, major producer, just added 4 million barrels a day for the past 4 years. You see a small decline kind of in you see a decline in oil prices, but the response you get from United States is another 45-degree angle, another 4 million barrels per day. So there was a lot of mental gymnastics, I'm sure, in a geopolitical landscape to say, hey, like this is like price wars. They're taking our market share, so we have to kind of take a position here. What's really interesting is that when oil price collapsed in the end of 2014, basically going from 110, 120 to those like 40s, 30s, actually jet fuel demand increased. You can see the rate at which it increased quite significantly. So going from, I would say, 1.5 million barrels demand to roughly 1.9. And obviously, if you think about this, it's cheaper now to fly because jet fuel is cheaper, oil prices are down. You have very low interest rates kind of going into 2020 in a way, or up until recently. And there's every incentive to travel, and that obviously adds to kind of more of an economic cycle where people travel and get those experiences. And I think there is something we have to appreciate, because as we're trying to translate this data to kind of our human experience as human beings, you think about this. Okay, 5 years prior to COVID-19, jet fuel demand was like at all-time high. It was only increasing because of the low oil prices. Now we go from that to like, don't go anywhere, don't travel, don't do anything, you can't see anyone, you can't go on vacations anymore. So there was like, even when I'm looking at those charts, I'm seeing like real human suffering that's taking place in the process, right? And what's really interesting about this is that there was this really quick recovery kind of in the 2021, summer 2021 timeframe, saying, you know what, yeah, I've been, locked down basically for a year and a half. I need to go. And we see a nice kind of recovery to between 1.5 to 1.6 million barrels on the fuel, on the jet fuel side. But I think what you could also observe from this chart is that you saw a price decline going from 120. Every time we saw a price decline, that incentivized more demand, just like what we've seen in 2014. And so when I watch, for example, data on Twitter from very smart people, Shabam is really into posting jet fuel data and basically flight and demand. It makes a lot of sense, not only because we're in this really weird period of time when we had this like, world pandemic, and we're kind of coming out of it. And I don't think people quite appreciate that this was a big kind of burden on socially, and especially on older people. And now people trying to kind of have that memory kind of eliminated as they continue living life more of a kind of experiences. In line with that, oil prices also declined, and so that maybe could create another incentive for people to travel. Now, one could say, hey, you're an oil and gas investor, you could have a bias. What actually happening here maybe is that Jerome Powell, through the interest through the Fed rate hikes, is basically inducing a recession, which could result in less demand. And that's a very fair point. And so I think we're in between those two worlds right now, where we're in this like really interesting environment where, historically speaking, people could start traveling more, but then we're in an environment that they potentially have less money and have a little bit more stress when it comes to their finances. And so what ends up happening here, I guess, is that because the oil is kind of like in this no man land right now, trying to kind of find its range, it's trying to really to test that the thesis whether the future demand is really a story, because we've been hearing a lot about this, but now we start seeing more and more jet fuel demand getting picked up. So as we look, let's say for gasoline demand is a little bit different in that time frame. You can see, and again, keep in mind, we have Teslas, we have electric vehicles, we have everything that's coming, on when it comes to not using gasoline. And look at this performance. We've been essentially ranging here between 8 million to, I would say, 10 million barrels on the demand side. And obviously right now, what ended up happening is that up until 2020, we had this very interesting, like cyclical, almost like extremely predictable behavior when it comes to the summer travel season. You can really see it in the graph where, like, for the past 20 years, minus the COVID kind of today, I guess post 2020, we've had very predictable kind of driving season, which probably made gas buddies' life very, very simple. But then look what happened here. We had a couple of shocks, right? The first one, that's the obvious one, huge drop basically in gasoline consumption because of COVID-19, because we couldn't literally go anywhere. That drop was kind of got to 6 million barrels a day, but then quickly recovered towards its historic baseline within a couple of months. And then you see very abnormal behavior when it comes to kind of human utilization of gasoline, because at this point we don't really have a choice or whether to go in the summer or fall or winter or whenever we want, because we're being told when we can travel. And you can really see on the gasoline demand, you can see kind of the waves in a way where you can see like immediate response. It's like, okay, we're back to normal. Let's start traveling. And I remember that because back then, end of 2021, I work downtown, and they say, hey, it's safe to come back now. So that's me basically traveling back, and then we're going to wave two. So starting December, January, around Christmas, and then we had to basically, the beginning of 2021, go through wave two. And then once we finished with wave two, there was a really amazing recovery when it comes to gasoline consumption, going almost to 10 million barrels a day, which was probably like the peak of it. And since then, we've been kind of in a weird way trying to establish our, historic seasonal behaviors, but we're not there yet because, some people took vacations in the winter, some maybe used more jet fuel to fly somewhere. People are maybe not traveled in some other months prior to that. So, okay, yeah, they can't see the video quality very well. Sorry, 1 second, guys. Oh, I think it's fine. Yeah, sorry, I think it's fine. Sorry you can't see, but maybe use a bigger computer because you're probably looking on your laptop. But I guess what I'm trying to say is that we're trying to establish some kind of level here of gasoline consumption. I think it's, as I'm looking at the data right now for estimated gasoline consumption, with roughly at 9.3 million barrels right now, and we've been 9.37 million barrels basically last week. So, and there's been very kind of strong demand on that side. And so the other thing I wanted to say about this is that it's going to be really interesting to see how this concept of EV integration is going to impact basically the gasoline consumption. But if we look at the numbers, you don't really see significant impact at all, right? You see kind of we're at this 9.2 and 9.3 levels, which is healthy. And remember that United States is a huge exporter of products now. It's not like you don't use those products and now you store them like we looked at the previous chart. Now you can export more products, and with China, potentially kind of picking up here and more demand, there is kind of opportunity for those growing demand countries to pick up on those products, but also become like big refiner kind of hubs within their own ecosystems, and maybe kind of bring in more of the kind of this human experience that we see here in North America for other people as they kind of transition maybe to EVs, but also as they still utilize the technologies that we currently use when it comes to kind of gasoline demand. Just kind of being logical about that. So if there was kind of a bear side, and I think that's why people looking at this from this perspective, but I don't think they should. I think what you're seeing here is that within the context of what I shared so far, this is only the commercial crude stocks, and this is kind of like the best explanation I could find to the current price environment, where we're basically essentially going sideways here, or kind of around 70s, trying to kind of find a place. But you can see what happened is that the SPR kind of distorted a little bit, and this whole kind of supply demand dynamic, whether like should we be producing more, should we like producing a little bit less, or like what are we doing here? And then you had this incentive to produce because you had elevated prices, but at the same time you didn't follow the slope of what was previously done through the two cycles. So what ends up happening here is that in this process, essentially the commercial stockpiles, so the commercial stockpiles are becoming a reason for the bears to say, hey, look, we're building inventories here. So essentially what ended up happening on the commercial side, if you look at the EIA estimated data now, we were roughly at the peak 3 weeks ago at 467 million barrels. And we basically dropped since then, and you can see on my graph there, would drop to 453 million barrels on the commercial side. And that's why I think it's really important to be really mindful of the numbers and talk about the actual numbers, and not to get emotional about, oh, you talk fundamentally about there's some good reasons maybe it goes. But I think it's really important not to be in this kind of echo chamber, and in a way look at the data and say, why is price dropping, why is it going sideways, what's going on here? And as more as we look at it, we're realizing that perhaps it's more kind of induced with kind of the emotion of what could be. So let's kind of address those. From the oil supply side, we clearly see today the rigs are dropping, and we've seen the rigs dropping phenomena for the past 3 years, basically. So since 2020, we've seen initial start to trying to produce oil as the prices were picking up. Uh, Horrible PTSDs from the producers. It's like, oh my God, another wave. Are we producing more? Are we producing? What are we doing? Basically going sideways. Definitely not catching up with the slopes we've seen historically, and you can clearly see this on this chart. Now, what's unique about the situation is that, and I know I think I covered it in detail, that first wave of going from 5 million barrels a day to 9, it was remarkable. Like, it was the perfect recipe for US shale boom revolution. Prices are elevated. You cannot go wrong. Let's say if you have a very unproductive well, you're still getting paid. Now, you really want to, it's really hard for you to let go of that. It's very difficult not to do this. So you come back and try again. The prices don't respond to you this time. If for the next 4 years they don't respond to you, and guess what? You just grow production. Just grow production, and you make situation worse. And in fact, prior to COVID 2019, in 2019, the average price was maybe like lower 55, like maybe 52, 53. But think about this: we don't live in isolation. Like, we as humans here, all of us in the space, people that are listening, we have a past. We have family, we have relatives, we have experiences, we have things we did before that we still do. We have things we've done before that we don't do anymore because maybe we're better off not doing those things. Those companies, those oil companies, they're the same organism, they're same bodies, they're same living organisms. They're trying to kind of say, what's best for us, what works for us, should we take this risk? And going through this crazy experience, right, of COVID-19, right now, clearly the production is not picking up. So when, let's say, I go on Twitter and people say, oh my God, they cannot stop producing oil. They're doing exactly the same thing like they always done. Look at this oil production. They just cannot stop. I knew it. I cannot trust these guys. Oil is going. Lazy work, very lazy. Look at the graph. Look at the actual behavior, right? Look at the overall response, at least by US shale producers. They're not increasing production here, nowhere close to previously. Previously, it took you maybe like a year and a half to catch up with previous highs and produce another 4 million barrels a day. Here, you having a hard time to even catch up with your previous production from like 4 years ago. And so I think it's really important to keep this in the kind of this context, right? Now, looking at what I think, in my view, like how do I view this? So I'm looking at the products, the SPR, and the stockpiles right now. We're 20-year low here on this chart, going sideways right now, testing. Right now, and oil price is about 70, 71 maybe today, a little bit. But I think what's happening now is like every week we have a $3 move because the inventory is increasing or declining. So there was an expectation of a big draw of let's say 10 million barrels a day, but there was a magical adjustment to that. And then oil price was like, hey, I'm gonna have a draw, but it's like, yeah, you did have, but there is an adjustment. So sucks to be you. You're going down, and we went down to $69. But think about this: we're in this range now of this 1.6 kind of billion barrels on those parameters that I've been alluding to. And again, I know I said it before, but I'll say it again. You could use any inventory data point for anything, and it will have probably something very similar. I'm just using US data. I really like that because I feel like most of us are US or Canada, and we're kind of looking at this data. And I'm trying to add to the story all the other dynamics, like the China angle and the Saudi angle. So you'll see a little bit more of that as I start comparing kind of kind of historic parameters. But what's happening right now is on that number, so total crude oil, petroleum products, and SPR, we had a nice kind of draw this week, right? So oil prices responded very well. The previous week, you would not tell that nothing changed. So 2 weeks ago, if I compare 3 weeks ago to 2 weeks ago, the estimates were 1.619 billion barrels versus 1.619 the following week. But within the adjustments and the expectations and the market volatility and everybody having a view about everything, we had huge shake and bake, huge. But for that number, nothing changed. It just stayed flat. We had some SPR being released. So, for example, this week, we were SPR was 349.9. Today we're at 348.6, which is basically halfway down or half full, half empty, the way up to you on how you want to look at it. At the peak, we were 740. And so there's the speculation now that, hey, maybe we don't need the SPR anymore. It's kind of like you have, let's say you have 2 lines of credit, and there's this magical line of credit that lower interest rates, and you don't have to pay it until, let's say, 2030, and you just don't care. You're like, oh, okay, I'm fine. I just borrowed some more from there. I don't need to refill it. And so there could be a view that maybe you don't need to pay it back. Maybe, in some point, President Biden says, just don't pay it back. We're good. You don't have to pay it back. But SPR is down essentially 50% right now. And it's kind of adding to the overall kind of supply demand of what's being produced. So the producers here, as you can see in this graph, as the rigs are dropping, they're kind of fluctuating here now. I guess the actual number I think today is 12.5 million barrels a day or so. On the estimates, they always underestimate, and they basically say it's 12.2. But on a relative basis, from 2 weeks ago, we were like at 12.4, and now it's 12.2. But realistically, we know it's 12.5. And then again, the other angle there is that we have some blending activities and among other things. So let's say 100,000 barrels a day, 200,000 barrels per day, plus minus, right? And if you take like a 12.2 million barrels a day and 200,000 barrels a day error, you end up with something that maybe could be unacceptable, but does move markets in a way, because we're already in a tight market in an environment where everybody's freaking out about another shock. And I'll give you an example. For example, what if, as you look at this chart, if you look, let's say, and again, I'm trying to be like kind of neutral here, even though I do have a bias because I'm investing in oil and gas. But what if the Saudis tomorrow, because they have spare capacity of roughly 2 million barrels per day today, because they're cutting a million starting July, which is tomorrow. So that's going to be interesting to see. And then they have another million through the previous cuts. They just, okay, we don't want to do this anymore. We're going to flood the market. This is extremely unlikely to happen, and soon we will address why. But this could happen if we have another COVID-19 scenario or COVID 2024 scenario. Yeah, oil price will drop. If we have a type of 2007 great financial crisis where there's some crazy crisis where just like 2007 2008 where everybody taking their keys from the home and just like leave it at the bank. Yeah, sure, there will be an economic shock, but I think living in this type of world where you kind of prepare for that case is extremely difficult when it comes to maybe making money, because remember, all those people that moved, the early humans, and that's kind of how I started the stock, also had like a thought process: do I take the next step, or I stay? Am I okay with my current environment, or I'm forced to move forward? And I think that's kind of the risk we take, in the stock market. Sometimes it's not for everyone, but it is for someone. So we're gonna have to be very mindful of that. So I hope like this initial couple of slides kind of make you appreciate kind of how I personally see it. Like, use it as an education or entertainment. Maybe you think it's funny and it's not accurate at all, and you have a different view. But at least that's kind of how I see it, and that's how I view it. Because I see a significant amount of kind of misalignment here because the stockpiles, the SPR, everything is being kind of dumped to the market, and yet there's no appreciation that we're like a 20-year low for that number. It's almost like in the past, like when we were at 2014 and we had the oil glut, we were okay to be at 1.8 to go to 2.1, but the fact that we drop like zero point 0.6 right now, zero point 0.6 billion doesn't mean anything. So for me, it means something. So for that reason, I think the decline in oil prices with decline in inventories, it's I don't know, I don't even know how to explain it. Okay, so let's talk now about and by the way, I'll talk about the oil glut, kind of the historic events a little bit here, and then maybe address some key points. Then we could continue the space, and I'll just kind of go offline on with the broadcast on Twitter and YouTube. I want to talk a little bit about the oil glut in 2010, and you can see what was happening place here. And right now I'm just using Wikipedia just to make sure I cover all points. You can see there was significant amount of surplus of crude oil, and it started in 2014, 2015. It's very evident from this chart as you were building inventories what was taking place. It really accelerated towards 2016. You can also see it in this chart, and there were several causes to it. And so I want to address those and kind of keep them in the context of what today. So for example, I will tell you a cause of what taking place, and you're going to have to ask yourself, is this something that's happening today? Maybe translate to explain the price movement in oil price, because remember, the implications are huge, because that's where some of the bears could say, hey, we've been there before, dropping that much, and maybe we're going to kind of 2016 levels, which were like $25 per barrel. So if you have cost of supply of $25 per barrel, you're probably okay. But if your cost of supply is 40, 45, you may be not okay. So some of the reasons: general oversupplies, unconventional U.S. and Canadian tight oil production reached critical volumes. So we talked about this, and we saw the 4 million barrel incremental production. Geopolitical rivalries among oil-producing nations, and start thinking, okay, back then the Saudis looking at the situation and like, wow, our market share is being lost. What are we doing? Do we see this geopolitical rivalry today between oil-producing nations? That's a key question. I would argue there's no big evidence of that, I don't think, because President Biden was begging oil companies to flood the market with oil because the oil prices were elevated as we had this inflation, which resulted in Fed rate policy. Now, you have today an environment where Saudis not only cutting production within the OPEC organization, but then in a way they take kind of the ROPEC angle of it without the R, saying, okay, Russia, you're doing whatever you're doing. Let's agree to disagree, but we're going to take an initial cut. So I don't think this geopolitical rivalry is representative of what was taking place in 2014 based on what we see today. The bears could say, oh, the Saudis just not going to have any more patience, they're just going to lose it in some point with everyone and just going to release all of that oil. This could happen, but I don't think it's unlikely to happen. And by the way, it could be famous last words, but that's just my personal view. Could be used for education or entertainment. It's up to you. But that's why I think it's not going to happen. An interesting fact is that the current leadership, the Saudi leadership, they're all young men in their 30s and 40s. And they need this price environment because they have this elevated price environment because they have ambitious plans to build the Saudi of tomorrow, the Middle East of tomorrow. And not getting along last time resulted in the graph that you see today, that you see on my chart here, where between 2014 to 2020, at the peak, you had maybe 70 here for like a couple of months. But in overall, the average, I would say, was like 40. Think about this. Just pause for a second. Between 2014 to 2020, average WTI price was between 40 to 50. Think about within the context of where we are today. And that was reality. That was real. And all of those companies went through this experience. Now, Saudis went into this kind of rivalry situation trying to punish basically the shale production just to see the shale production second leg recovering with a bunch of incentives, thinking they could get paid like they got paid last time, which they didn't. And so I think everybody has a little bit PTSD here, and also young leadership thinking forward. Okay, we didn't get along before. That didn't result in elevated prices. Maybe we could get along this time. Okay, another reason for that oil glut was falling demand across commodities markets due to deceleration of the Chinese economy and possible restraint of long-term demand as environmental policy promotes fuel efficiency and steers an increasing share of energy consumption away from fossil fuels. This was like the time where ESG was just really starting to pick up. Greta was like really popular back then, trying to talk, kind of like we have only 5, 6 years to survive, all of us, and we're not going to make it. Going into this low price environment, as the jet fuel was picking up actually, and gasoline was very steady, with all the money that was flown into the electric vehicle kind of, in their sector, we still see very elevated demand for gasoline and jet fuel, especially in prices when prices are lower. And we saw a lot of evidence of that. And maybe I'll use this opportunity to show again the chart when it comes to jet fuel consumption here. And you can clearly see that when the price is declining, it really accelerates demand. So it's going to be fascinating to see with that decline we just experienced. There's a small lag too. It doesn't happen just right away. I think on this chart, it happened between December 2014 to, I would say, July, maybe August 2018, where you saw that lag going from 1.5 to 1.7 million barrels per day demand increase. And which is interesting because back then, and we read about this now, the Chinese economy kind of, it decelerated in its growth. Now, the question now is the Chinese economy decelerates? If you want to become a superpower, an economic superpower, are you going to on purpose decelerate, or are you going to accelerate your economic activities? If you want the United States not to be a superpower, and you want, if you're China, to be the super, are you going to accelerate or decelerate? And so I think right now, even though the Chinese kind of recovery from coming out of COVID is shaky, the overall trend is for China to be stronger for longer. So that's kind of, I think, the underlying difference between what was happening back then and what's happening right now. And you guys could disagree. When it comes to environmental policy that promotes fuel efficiency, this is still very much ongoing. But let's be honest that this has been going on for a very long time. And, despite that, or in addition to that, this is the current gasoline demand, as you can see in the chart here. So, and the estimate for this week is basically that we're going to be driving in the United States, and by we, I mean you guys, 9.3 million barrels per day consumption, which is kind of very nice in the range for historic consumption, despite the competitive kind of technologies that come online mainly from the EV sector. Okay, let's talk about a little bit more about the oil glut from 2010. So the world oil price was above 125 in 2012, as you can see basically in this chart that I will show you here. And let's see how US production was responding to that. Yeah, very nice price, and remained relatively strong above 100 till September 2014. You can see it in this chart, after which it entered a sharp downward spiral, falling below $30 in 2016. So why did this happen? Why did it fall below $30 in 2016? OPEC production was poised to rise further with lifting of international sanctions against Iran. So this is another thing that's really interesting, right? Because if you were, let's say, a bear, let's say on oil, and you're like, hey, sanctions against Iran. But I think by now we kind of know that the Iranian barrels kind of were always produced and always found home, just similar to what Russia is doing right now. So maybe the risk from what was shared before, maybe it's not as serious today. But nevertheless, we do still see some conversations about Iranian production. This was at a time when the markets was already appeared to be oversupplied by at least 2 million barrels per day. And again, the Saudis, the OPEC, they're taking proactive steps in cutting 2 million barrels per day. What is that now? 8 years later, right? So Very different environment, guys. Very different environment, regardless of how you think about this. It's just reality. It's not my biases. It's not what I think or you think. It's just reality. The messages we get from Saudis, they're not the messages we were getting from Saudis when they were very aggressive in 2016. I'll give you some insights towards what was said in December 2015 in the Daily Telegraph. There was a quote by a major oil broker saying, "The world is floating in oil. The numbers we're facing now are dreadful." This was in the Forbes magazine. "The ongoing oil price slump has more or less morphed into a complete rout with profound long term implications for the industry as a whole." This was said in 2016. And guess what? This person was not wrong. Going into the COVID 19, oil price never really recovered from that point and epically ended up at the negative territory. So can we say that today? Is this quote going to be applicable today? The world is floating in oil. The numbers we're facing are dreadful. No, this is not reality. This is not the environment of what was said today and what is today. In fact, today we see a 20-year low on the stockpiles, at least in the United States. So 2016 kind of continued, and the price gradually rose back into the 40s. Think about this, 40s, right? With the world waiting to see if and when the market will return to balance. So in October 2018, as you can see on this chart, Brent prices had recovered to the 2015 levels, peaking at the $86 in October. But soon after, prices began to collapse as fears of global economy and fast increasing shale production began to take hold. So that happened in 2018. Look in this chart in 2018. You have recovery. Look at the oil production while all of this is happening. While all of this is happening, all of those concerns, U.S. shale doesn't care. U.S. shale doesn't care. U.S. shale, in fact, goes from 10 million barrels per day to 13. So in the time frame, U.S. shale is like, okay, you know what? Yeah, we may be going to experience here big issues with demand, and we have this huge oil glut. But guess what? We're going to produce another 3 million barrels a day. So, and I think that's what some of the difference between what we saw then and what we see today. So the following month, Brent prices fell to 22%, and you can see like a huge sharp decline, constituting the largest monthly loss in a decade, ending the month at $59 per barrel in November. And so in early 2022, Brent prices actually recovered to their pre-2015 levels, and the prices reached in 2018. And so I think it's kind of important to be mindful of all of those events that were taking place during that glut. Now, a couple of key points here that we want to address, and maybe we can talk about this in the space a little bit later. North American oil production increases. Obviously, this is not taking place. I think I showed a good case here where, there was, and think about this. These are business operators. These are entrepreneurs. These are corporations. That's what they do for a living. Going through the waves, going through supply demand, having debt on the balance sheet. You just went through 6 years of pain, basically not making any money. Now think about the fact that you had debt. If you had debt, what do you like? So what many companies did, they took advantage of this bump and paid down a lot of debt. So they really delevered, right? And which is great. Many of them trying to incentivize increased investment by issuing dividends, which I personally think everything I shared so far about the oil glut of 2010s, do you really think it's a great environment to pay increased dividends right now in the oil sector going into this uncertain environment? It could be, but I don't know, maybe it's like my biases where I was a little bit still kind of PTSDing like everyone else that works in the sector and thinking, don't just keep the money, paying down debt. Maybe if the shares are cheap, buy back shares if you can, right? So that's kind of I'm not using it against anybody. And these companies almost had to do it because they had to incentivize investment into their companies in the time where nobody cared. And we hear a lot about this on Twitter where, investing in oil, why? Over the past decade, it just sucked. They cannot stop producing. They produce just so much oil. As soon as they see price increase, of course, whoever says it, they're right because it happened. But guess what? The current environment is not that environment right now. There's no 45-degree slope. The rigs are not growing. Could it happen? It could happen. Is 70 is an amazing price right now, relatively the prices seen since 2014? Absolutely. Those will be the peak prices going for the past decade. Um, but at the same time, I'm thinking, okay, well, you went through this entire journey. Are you being incentivized now to grow infinitely and get yourself into that situation that you had before? Or you incentivize as a management team to buy back shares, maybe reduce debt, maybe to kind of prepare for the bad times that could be coming, or maybe will not come, but just be a little bit more cautious. And I think there is a lot of evidence here that like increasing production into 2017, 18, 19, 2020 was just, and not getting paid was kind of like, it was an ecosystem that maybe one could argue was not sustainable, right? At the same time, it makes you wonder, wait a second, why did this keep, like, why they kept going with this? Like, were they getting paid? Were they making good money? While WTI was like between 50 to 60? Are those businesses sustainable at those prices? Well, many businesses were not. We saw a lot of kind of M&As and bankruptcies during that time period, but at the same time, whoever survived went through this valley of death and came on the other side, and now we're here. And we have to be very open and frank about that we went through this journey already and we ended up here. So, global growth slowing. This is valid for today as well. So, if there was like a bear case, global growth could be slowing here, especially with the Fed rate hikes. Are other countries like Japan doing what Jerome Powell is doing right now? No, but does it have an effect on one of the biggest consumers in the world of oil and gas? Yes, for sure. I'm sure not too many people are happy about paying more interest rates. But again, there's a different dynamic here. In Canada, for example, our mortgage rates, they have a term, let's say 1 year, 3 year, 5 year. Right now, maybe like a 3 year could be like maybe 5%, let's say. I'm not sure exactly what it is today. But in the United States, the terms are very different. So you can have a 20, 30 year, whatever mortgage rate. So I'm not from the United States, so I don't know exactly. But you may not have even felt the increase in interest rate. And my understanding that many did not. And so how is that global growth slowing 2015, 2016 timeframe? And this whole thing that happened in the Chinese stock market and the turbulences back then are correlative to what we're seeing today, right? And so today, back then, China's slowing economy led to other economies slowing by falling into recession. And there was like the end of quantitative easing in the United States also contributed back then as well, right? Even though the rate stayed very low for a long time. And so I think it's up to each and every one of us to kind of say, okay, well, is the demand really going to be impacted? And that's why I think we see such a huge volatility kind of on the weeklies when it comes to estimates. And that's why it's very difficult for people to hold, because it's just, you look in kind of at what's happening. It's not, but, and by the way, I am an investor in the sector, 100%. I do have a bias. My view that I'm bullish on this, even in this price environment, because I think the cost of supply that was realized over the many, many years of suffering is really benefiting now those companies that manage to pay down debt and have low cost of supply. But nevertheless, do we see geopolitical rivalries today like we saw in the oil glut event? No. Combating climate change. Remember the concept of climate change, environmental impacts of fossil fuels, government policies promoting zero carbon energy sources. In the oil glut kind of time frame, it was very new. Like scientists will say 5 to 6 years and we're all underwater. Huge concern, ranging from climate change to smog, severely hurt the notion that oil demand will forever rise, right? And there was this like psychological element. But guess what? As we're looking at the oil consumption, right? So that's gasoline estimated demand. This is jet fuel. This is production. This is inventories. Is there kind of a message you see here that it's going away? Like I personally didn't see that it's going away. Do we have the same um, type of environment where people questioning that oil is just going to disappear tomorrow? The next, I don't think so. I don't think most people, kind of realizing that we've gone through this journey for the past 10 years, looking at kind of carbon tax implementation programs, increased taxes on gas, which we've been seeing. We've been seeing alternative energy sources, wind, solar, the subsidies associated with them. That was new back then, uh, but it's not new today. Uh, the worry back then was that it's going to basically eliminate oil demand, but that's just not reality of what we're seeing today. And so I think it's really important to be mindful of that. And I think the biggest one is OPEC, right? So if I was to kind of summarize OPEC in 2014, they were really affected uh, in 2014 by the collapse in oil prices. They were really affected. They had to do something, and that something that they've done was in the form of kind of rivalry. They flooded the market. The market, as you can see here, that exercise resulted in collapse in prices. I think that drop here, end of 2014, really correlates. Huge drop from. Can you imagine you go from 110 and you do your budget, and all of a sudden within like practically like a month you go down to like $40 a barrel, and you you kind of, hey, we're gonna drill that much next year, and and let's see like end of 2014, 2015, what response the shale producers had in that time frame. Again, this was the first leg. Guess what? No response whatsoever. You had even a little bit continuation as the oil prices were dropping, but then towards kind of October 2015, you know, as the summer was ending 2015, the oil price maybe recovered a little bit, and it was like, okay, we have to respond. So it really like curved down, and it basically went down to I would say 9 million barrels per day from 10 million barrels per day. But guess what? You just increased production by 4 million barrels within like 3 years. Um, so I guess everything is kind of on relative basis. So just kind of to summarize on the OPEC portion, so it really impacted them. Shale production just absolutely robbed OPEC of a large portion of the market power and forced it to cooperate with other producers to keep prices up after Saudi Arabia effectively declared defeat in price war in 2016. Now, I don't know exactly if they did, but I'm reading now from Wikipedia. But let's see what happened in 2016 when this happened. We saw a slight recovery in oil prices going from 45 to maybe 75. And so the question is, are they going to do this again? Like we have to be very honest about the strategy that was implemented but never worked. And are they going to go and do the same thing again right now, which could be a risk, but I don't think so. So many OPEC members, such as Venezuela, Algeria, Libya, Iraq, Ecuador, Nigeria, have had internal crisis spawned and worsened by the collapse in oil revenues. In many of these nations, the response to the 2011 Arab Spring was spending oil money for internal stability, which has caused financial troubles for them as oil revenue dried up. Now, this is the question for you. Knowing what you just heard, are any of those companies, like, and we've heard some conversation from OPEC that Nigeria had some issues there, and somebody was complaining, I think, Iraq, or about their quotas. Knowing what we know about what took place and how this money is being utilized, do any of those countries have any reason to basically do what took place 10 years ago, right? And I would argue no. Their natural response will be to collaborate and advance basically an environment where there's price stability. And I think kind of the Saudis are kind of leading the way when it comes to that stuff. So this was basically me trying to summarize, promoting to take a view of maybe zoom out a little bit from the weeklies and kind of better understand what 2010s look like than whether we are or not in oil glut situation, which I truly believe we're not. I want to cover a couple of points here before I close the Twitter live and YouTube live, and maybe open the Twitter space for more dialogue. Balance sheet. So as companies were survived and oil price collapsed in 2020. Obviously, budgets were cut. I personally witnessed significant amount of layoffs, 2015, 2016, 2017 timeframes. I think I shared this before, but my employer, I think, laid off. I always worked for majors. Today, I work for a super major as well. I think there was one round where 700 people lost their jobs. I still remember looking down from Calgary downtown and seeing all the cabs picking up people. It was very sad to watch. But in the process, those companies became extremely lean when it comes to their spend, the amount of people required to run the operations. And so this was quite a journey for many of those companies, and I don't think we talk a lot about that. So current price environment, I think, my personal view is that it's really about kind of the concept of baselining inventories right now. There's basically, as you can see in the slide, when it comes to stock total crude products SPR, nobody cares that we're at 20-year low right now. Nobody cares that the SPR was drained by 50%. There's this kind of expectation, although like we will not need any more of the products, and we're going to have this recession or the situation. But this is definitely, I don't know if that's going to be the case. Okay, so the business cycle, of course, it's kind of an important angle here. Incentive to produce more oil. Right now, are the budgets aligned basically with what's happening here? Are management teams getting paid to produce more, or maybe fix the balance sheets and maybe improve kind of investment to the sector by buying back shares, maybe reducing debt, stuff like this. So where are we in the business cycle? Are we in this environment here where you want to grow production at 45-degree angle, or you like, hey, I'm just going to sustain. I'm going to make sure I'm low cost of supply. I'm going to be responsible. I don't want to take on too much debt. The only way I'll treat debt maybe if it goes down. I would argue majority of companies, not maybe the more aggressive companies that look into reposition or grow and, but majority of companies probably like, hey, we went through the cycle. We're going to appreciate it. One could say, well, you're being too conservative. You need to kind of be taking on more debt now, and maybe as the cycle continues, you will be benefiting more. This could be the case, but I think historically speaking, based on what took place, we cannot ignore this company are actual like entities that went through this experience and will act in a certain way, regardless of how we feel about how they should be acting. Okay, so are management teams getting paid to grow right now? I would argue most are not. OPEC, you see basically Saudi management now, or I guess leadership teams, men in their 30s and 40s. They really want to do the right thing, I believe, when it comes to getting together, kind of collaborating, coming with solutions together, saying maybe this time I'll cut, maybe next time, something along those lines, versus engaging with each other and kind of going to price wars. Slope of supply, we can put this to rest. If we were at the same supply growth in the United States as before, we would be now at roughly 14.5 million barrels per day. This is definitely not the case. So 2011 to 2014, you can see the prices were sustainable as the production grew. But then what was happening place here is that I don't think the U.S. Shale revolution in a way was kind of getting much respect initially, like from what they could deliver. But then in the process, the rigs never dropped. You do not go and drill, like produce at 45-degree angle over 4 years by dropping rigs. So there was more capital coming to the sector. Do we see it today where rigs are not dropping? Well, we see slightly the opposite. Management teams are buying back shares, reducing debt, and incentivizing his men with dividends. We'll see what kind of come out of it, but the oil price probably could be testing kind of this range here to see whether we have increased demand or maybe supply going to decline. And yeah, it's important to remember that low cost of supply is really important, and that's kind of where we're at. So at this point, I'll just kind of open the space for speakers on Twitter. Conclude my presentation broadcast on Twitter and YouTube. So thank you all so much for listening. And please, whoever is on Twitter Spaces, stay. And we're going to have a longer conversation. So thanks so much.